like I'd say a sequel to another presentation I did in November. And I'm going to go over some of the important things that I went over in the previous presentation. And I guess you have a link to that so you can take a look at it maybe at a different time. But that's a really good presentation. It gives a little bit of background, not only with my personal experience working in this industry and nuances of the cannabis industry over time, where we were prior to the Tax Cuts and Jobs Act, up to now, when procedures started to take place for the rescheduling of cannabis. And so this is kind of like maybe a little bit more in reverse. I'll touch on a little bit of my history working in Southern Oregon, where we have a lot of outdoor growers. Of course, Oregon was one of the earlier states to go medical and rec, along with Colorado and Washington. And so we had to really get on our game pretty quick in terms of cannabis regulation. And at first I wasn't really taking 280E serious because I was doing farm returns and whatnot, and most of their costs are deductible. So I didn't feel like it was that big a deal. But around 2014, when dispensaries started to roll out, and then I started to implement 280E and really looked at it, I was like, wow, this is crazy. These guys are paying 70 to 90% effective tax rate. $100, every $100, they'd pay $70. So it was impossible. They couldn't stay in business. Even the ones early to market, they're making more money, but all of that would have gone to tax on phantom income had we not done anything. And I'm actually still surprised to this day. There are accountants that are not using any tools for mitigating 280E, and we are so far from that. So if that's your case, you need to reach out to somebody who specializes in the cannabis industry. But now we've got some really good tools. 471C is probably the most used right now, and I would say the most conservative approach that you could. It's conservative, and as far as I'm concerned, a low-risk option for people to mitigate 280E. And now we've entered a new era in which the debate as to whether or not cannabis should even be considered a Schedule I drug, and prior to the DEA's rescheduling to Schedule III. And the purpose of this presentation is to go a little bit more into detail there, talk to you and describe why I personally believe that 280 does not apply right now, and I'll go into where it's not certain. The IRS definitely disagrees, and the DEA disagrees. So we'll talk about where they're coming from too. Here we go. So I'm going to try to look at my slides on my screen while also navigating with you guys. All right. So I think we're on what is IRC 280E. I don't think we need to go over that. If you're attending this webinar, you guys have an idea of what that is, and you can do a quick Google search on it and how it impacts your cannabis tax returns. Let's go to the text of 280E. Raquel, could you go to the next slide? So this is really important, and this is what, for whatever reason, I don't know why this isn't more out there. I know that the debate is still on, and the IRS will disagree with us in terms of whether or not 280 applies. But if you look closely at the language that is included in the actual code, if you go to the code itself and you read about 280E, you're going to see that it says very much specifically that 280E applies to carrying on any trade or business if such trade or business consists of trafficking in controlled substances within the meaning of Schedule I and II of the Controlled Substances Act. My slide's a little off there. I accidentally put with the meaning of Schedule I, within the meaning of, and I almost did it like unconsciously just to emphasize the importance of that specific language in this text. So the question, the debate is, does cannabis fit the meaning of a Schedule I or Schedule II, or you can look at it as the definition. Does it fit within the definition of a Schedule I or Schedule II drug of the CSA? Well, the next slide, if you go to the next slide, Raquel, what are Schedule 1 and Schedule 2? Well, Schedule 1 substances are substances that have a high abuse potential, no accepted medical use, and lack of safety under medical supervision. An example of a substance that is a Schedule 1 drug is heroin. And then Schedule 2, high abuse potential, some accepted medical use, and this is specifically taken from the language out of the CSA, severe psychological or physical dependence. So examples of Schedule 1 are heroin. Examples of Schedule 2 are cocaine, methamphetamine, oxycodone, and fentanyl. And we know the damage that fentanyl is doing to our society right now. And then, of course, we got oxycodone, which got everybody doped up and addicted to opioids back in the 90s, right, when the pharmaceutical companies were pushing it all over the place. So let's go to the, so now in August of 2023, we put the HHS, Health and Human Services Department, the secretary sent a recommendation to the DEA saying, and this was actually after President Biden requested that they reevaluate whether or not cannabis actually ought to be included in a Schedule 1 or Schedule 2 drug. And so then the Secretary of the HHS responded by doing a very, very robust document along with this letter that went to the DEA to essentially suggest that cannabis ought not be Schedule 1 or Schedule 2. Cannabis should be a Schedule 3 drug. If you go to the next slide, I'm going to zoom in a little bit. If we can zoom in, I don't know if you can see this, but here's the exact language from the letter itself. Upon consideration of 8 factors, determinative of control of a substance under 21 U.S.C. 811C, the Food and Drug Administration, so that's another agency, not just the HHS, but the FDA recommends that marijuana be placed in a Schedule 3 of the CSA. The National Institute on Drug Abuse has reviewed the enclosed documents, which were prepared by the FDA's controlled substance staff and are the basis for FDA's recommendation, and concurs with the FDA's recommendation. Marijuana meets the findings for control in Schedule 3 set forth in 21 U.S.C. 812b3. And so, I mean, that's pretty big. That's the HHS, the FDA, and the NIDA essentially recommending that cannabis be rescheduled to Schedule 3. And then, and then of course the DEA is like, okay, well, we'll think about it. There's procedural things that we need to do. Let's go to the next slide. So in that same document is a section. If you download that document, which you can, if you download these slides, there should be a link to this document, or you can just Google it. But underneath that letter is considerations for whether a section called considerations for whether marijuana has a currently accepted medical use in the United States for purposes of Section 202B of the Controlled Substances Act. I'm not sure. I think 202B was the number, but that seems unfamiliar for some reason. In it, they use the HHS uses a two-part test to determine whether or not there's medical uses for cannabis. The first test is current experience with medical use of marijuana in the United States by licensed health practitioners. That was test number 1. Test number 2 is FDA evaluates whether there is some credible scientific support for at least one medical condition. I'm realizing there's a few typos in here. I don't know why I did this like a 1 week from tax season. I meant for this slide deck to be like slides, and now it's 35. So please forgive my typos in there. So the results of part 1, more than 30,000 healthcare practitioners are authorized to recommend the use of marijuana. So what this is referring to is the states that have medical programs and the people who are responsible for providing cards and whatnot. I think that is what they're alluding to. But there are tons of healthcare practitioners out there that recommend the use of cannabis for all sorts of issues, primarily pain. I think we can go over that. Primarily pain, nausea, those kinds of things. You know that people are using that kind of thing for maybe cancer patients. Glaucoma is the famous one that Peter Tosh sang about in his reggae song. It's clear. I know that there are healthcare practitioners that use it for relaxation, sleep, all sorts of things. Like, is it debatable? Are there healthcare professionals using this? It's not debatable. There are. Results of part 2. There's some credible scientific support for the use of marijuana in treatment of pain, anorexia, nausea, and vomiting. And really, some is all we need. Really, it's just currently acceptable medical uses. If you go to the next slide, we've got 2 actual pharmaceuticals that are being prescribed. One of them is a Schedule 2, but the other one is a Schedule 3, synthetic THC, that is a Schedule 3. So I question, like, if these are a synthetic THC, so what about the botanical cannabis plant makes it a Schedule 1 substance when there's a synthetic THC, which the THC is the psychoactive substance that's being prescribed as a Schedule 3 drug? You can ask that question too. Okay, so there was that, and if we go to the next slide, so there was that, the HHS's letter to, and recommended the FDA and the HHS's recommendation to reschedule from Schedule 1 to Schedule 3. And then in April of 2024, we got a really great memo from the Department of Justice's Office of Legal Counsel. And in that letter, it pretty much said that when reviewing the test that the DEA used to determine whether or not cannabis ought to be considered a Schedule 1 drug, the test to determine whether or not cannabis had medical use, they found that it was impossible for it to be considered to have medical use. The Office of Legal Counsel said that the test was impermissibly narrow. And then it endorsed the HHS's 2-part test, the one that we just reviewed. Are there healthcare practitioners that recommend it? Is there studies that have shown that cannabis has medical use? And both yes and yes. So it passes the 2-part test. So I'm going to show you, if you go to the next slide, this is where the debate continues to be. And at least from my perspective, I'm not absolutely sure where the debate lies, but I do know that where the IRS, I think what the IRS is leaning on and the DEA is leaning on in order to, or the IRS is leaning on to determine that, hey, they still have a position, comes from this part of this letter. If you can see here, the first highlighted part is saying, well, impermissibly narrow, and then it says that the DEA is bound by HHS's recommendation, but only until formal rulemaking is started. So if I recall, there was a very little time between the time that the HHS said that they should start rescheduling and when the DEA started the rulemaking. So the DEA is not bound by the HHS to reschedule because rulemaking procedures have started to happen, and therefore the DEA is no longer bound by the recommendation. And so therefore, opponents of rescheduling are hanging on to this, saying, well, it's still up in the air as to whether or not cannabis has medical value because the DEA hasn't finished its process. It has, and I don't honestly know what all of that is. I've been following it for quite a while, but I'm not an attorney, and I should have probably told everybody that at the beginning. I'm not an attorney. So law is not something that I am a professional at, but I am also a rational, logical person, and I can read read information. And when I read the articles about the DOJ's rescheduling, it felt to me like everybody in that, everything that was happening from the judge level down to the people who were doing testimony was really opposed to rescheduling. And ultimately, in the end, it's the weirdest thing. The judge decided to pause the process because of a lot of shenanigans having to do with the witnesses, the opponents to cannabis rescheduling. Does that make sense? It was really weird. Why is the judge stopping the process because of shenanigans that had to do with the opponents to rescheduling? So as a punishment almost to rescheduling, they stopped rescheduling, or as a punishment to those people who were opponents they stopped rescheduling. How? It just doesn't make any sense to me. And so ultimately, everything hinges on the fact that it's not binding right now. But if you look at this, you can also see that the DEA must continue to accord HHS's scientific and medical determination significant deference. So meaning that while these processes are going on, the DEA has to take into consider HHS's, and it can't, and this de novo thing means that it can't start a new study, its own review. It has to lean on the findings of the FDA, the NICA, and the HHS. So that's where there's still a hang up here. That's where the DEA has authority to not reschedule automatically, and therefore the IRS is still saying, well, until it's a Schedule III drug, we're going to consider it a Schedule I. Well, there was a really good article that came out just last month by a guy named Mason Marks. You can look it up. Again, there's a link. Separation of Drug Scheduling Powers. And he makes a really good argument for saying that, hey, and essentially it's a very logical argument. Why doesn't the HHS is a scientific entity, and the DEA is a policing entity? Why in God's name would cannabis, the debate about cannabis not having medical benefits, still be a debate? Why is it a debate? The DEA is an enforcement entity, and the HHS is a scientific entity, and so is the FDA, frankly. So why is it having to kowtow to the DEA? And ultimately, the language is like, well, the DEA has the right to determine what impact cannabis has on society and whether it truly is dangerous or not. And then on the other hand, it's also gets the opportunity to determine whether or not it's a high level of abuse. And I think I forgot to mention in here, I think, or maybe it'll come up, that there's been no, the FDA determined that there is not a high probability of abuse. It's much lower than, of course, heroin and cigarettes and these kinds of things, other comparable substances. And it's never resulted in an overdose. There probably have been deaths. I know that a kid got into some edibles, and there was a tragic issue there, but that was like the first one in history. He said that there's veto powering, that he argued that the HHS potentially has veto power, and really the scheduling should be between both of them. The DEA and HHS should be the ones who together should decide if it can be rescheduled. And then finally, to hit the point home, he points out, if you go to the Controlled Substances Act language, in the language, the Controlled Substances Act language, if you go to the evaluation of drugs and other substances, you'll see, I highlighted here, the recommendations of the secretary to the attorney, that's the HHS, to the Attorney General shall be binding on the Attorney General as to such scientific and medical matters. And if the Secretary recommends that a drug or other substance not be controlled, the Attorney General shall not control the drug or other substance. Now, granted, it's not saying that if the HHS recommends it's Schedule 3, it ought to be Schedule 3. It's saying not controlled, but I think it's essentially saying the same thing. It only makes sense. All right. So I don't know if I can hit that one home any more than I can, just that I've done. So please feel free to peruse this slide deck and look at the documents yourself and maybe make a call. If you were to have to go to tax court for this, would you have a chance of winning this? And granted, I don't know if it's gone to tax court yet. I know there are people using this argument to amend returns moving forward without reducing deductions to 280E. So the next slide, what was Chevron deference? So this is also an interesting development. This is essentially the Supreme Court in Loper Bright Enterprises versus Raimondo. The Supreme Court overturned what's called the Chevron deference. And if I'm understanding it right, and again, I'm not an attorney, but essentially what it was doing was giving the agencies, the federal agencies, essentially to write law. That one right there, thank you. And so not write law, but it gave the regulators more power to enforce the law. And so whenever we as a taxpayer had an issue with, say, the IRS, we would have to settle it with the IRS first. And then going over them to the judicial system, that was very difficult to do because they had precedents gave the agencies more authority. And it was really, well, I think the Loper Bright thing was more about environmental control. And now the people who may say want to exploit the environment might be able to find loopholes in the law and exploit the environment. And then the EPA say can't come down and say, hey, you're exploiting and we're going to get you. Instead, they have to defer to the judicial system, which for cannabis could be a good thing because you're not being blocked by the IRS anymore. You can go to the court system and argue this in front of rational, not necessarily biased judges, I hope. Again, this hasn't gone there yet, but if it were to go and when it goes, then it's actually potentially going to give us a lot more power. So when our argument gets there. Now, if it does, essentially there was a really good article by this guy Narodsky, and he talked about the Chevron deference in length. If you want to go to the next slide, there's also a link to look at his article, and he talked about the opportunity to challenge 280E, that it actually has strengthened our ability to go over the IRS's head straight to the court system and argue our case if needed. And there's also another, when I talk about the 471 section, that is also a really good, the Chevron deference really helps with that, and I'll tell you why. So bottom line is the IRS insists 280 still applies until DEA's final rule. Legally, in my opinion, cannabis no longer qualifies as Schedule 1 due to the HHS binding findings. If you also take into consideration the CSA's little blurb that I included where it said in the CSA that this recommendation by the Secretary is binding, even though the Office of Legal Counsel in their memo said that it wasn't binding. I think people should look at that. I think that's really important, and I think it strengthens our argument. This is effectively ignoring the law's substance by clinging to the old label. Court's likely to side with the current facts. Cannabis out of Schedule 1, so 280 doesn't apply. Schedule 1 and Schedule 2, it doesn't apply. There is, and then I don't want to take too much time. I've already taken a lot of time, but there is still the Canna Provisions case that's moving up up the ladder about whether or not it's constitutional for the Controlled Substances Act to be imposed on states with their own cannabis development or regulations. We had a couple of, if you want to go to the next slide, sorry about that. I'm moving through my slides, but where are we? And how about the next slide? I'm sorry, I got lost there. So Canada provisions is still in appeal. There's mixed messages on whether or not this argument is still a valid argument. I think they're moving forward. I think it's still a very valid argument, actually, because we have definitely seen a move from more of a federalist to a states' rights movement. We've got 6 Supreme Court judges out of 9 that are conservative that have been regularly voting to turn over other federal laws in favor of states. So if this gets up to the Supreme Court, it's very much likely that the Supreme Court will rule in favor of these companies, which would mean that cannabis ought have never been a Schedule 1 or Schedule 2 drug, and therefore 280E should have never actually applied. Let's go ahead and go to the next slide. Maybe go two more. So arguments against 280E, there's additional arguments. I mean, I just described them, that the 10th Amendment, so some people are arguing that, hey, this violates the 10th Amendment. This is, cannabis regulation is definitely a states' rights thing. Let's go to the next one. To support that, we had the Murphy versus NCAA 10th Amendment victory, where there was a sports betting company that the state legalized sports betting in New Jersey, and the federal government was like, no, and then they went and took it to the Supreme Court, and the Supreme Court said, yes, that's a states' right issue. So sports betting is, if states have their own, they get the opportunity to do that. Versus Jackson was huge. If you go to the next one, that was where the Supreme Court essentially overruled Roe versus Wade, which is tax court precedent that's been around for years and protecting women's rights to choose and whatnot. And yet this conservative Supreme Court, overruled that. So now states have the right to ban abortion. So if states have the right to ban abortion, why in the hell can't we have our own cannabis regulation? It's insane. Okay, if you go to the next one, Fifth Amendment challenge to the 280E. This is an amendment that the government from imposing crushing tax liabilities and penalizing companies like the federal government is not allowed to impose penalties on companies. And that's exactly what they're doing with 280E. If you go to the 8th Amendment, oh no, this is the 8th Amendment. I apologize. I'm kind of getting behind on I'm in a hurry to get to the 471C part. So then we have the next one, we have the 16th Amendment. I don't know if you're there, there we go. This is where Congress is not allowed to tax on non-taxable income or phantom income. Essentially, it's saying that, your government is required to allow reasonable and usual business deductions, but yet they're not allowing that, and they're taxing you on phantom income. And that is unconstitutional according to the 16th Amendment. All right, very good. So one of the things that people ask me is like, well, what about this 471C thing? And I wanted to talk about that again, because that is like the new conservative thing to do. If you don't want to go aggressive and you don't want to reduce deductions for 280E completely, you can use what's called 71C. Prior to the Tax Cuts and Jobs Act, we were using what was called 471A. It was where we would do like a square footage schematic and deduct some of those based on proportions of the square footage that were for inventory management and packaging and processing versus the square footage that was on the sales floor, which was not considered deductible. Then we would also would bifurcate payroll. We'd say, hey, if you're bagging and tagging, then that's deductible payroll. If you're in the front, many of you, if not most of you, you have some kind of method that's similar to that, like 471A. The thing about 471A before the Tax Cuts and Jobs Act is that that 471 is for manufacturing companies. Even though we kind of found that as a loophole, it really wasn't a very defensible because it was for manufacturing. So if you're a retailer doing that, it was like, it's reasonable and let's do it, because the only way we're going to get our tax liability down to any kind of reasonable level so that we could stay in. Ultimately, if the IRS wanted to argue that case, they could, and they did. They would. But once the Tax Cuts and Jobs Act passed in 2018, 471C superseded 471A, and it opened it up to all businesses. And this was so beautiful at that time, because then what happened was, it was like the code itself is so simple. Any business under 29 million can use any methodology to capitalize and calculate its inventory, as long as it conforms with its records, your company's books and records. That was, it was a little bit more complicated than that, but that was the gist of it. And then when we learned about it, all in on that. Well, that means, and some people were abusing it, but that means we're going to deduct 100% of payroll, 100% of facility costs. We're going to, anything that's essential to conducting this business, we're going to calculate it and take percentages and add it to inventory, and then match our inventory with, or our income with, our cost of goods sold, and then move it into cost of goods sold. And there was a lot of people doing that right out of the gate, but some of them were moving 100% of inventory and essentially really poking the beast at that point, like moving 100% of their overhead costs and all their expenses into cost of goods sold. And the IRS got word, or the governing body of the IRS got word, that people were taking advantage of 471C, and essentially told the IRS to do something about it. So if we go to the next slide, okay, so what they ultimately, the IRS was like, okay, and they put like blanket regulation down. Now, for those of you who are not familiar with regulation, what regulation is if there's ambiguity in the tax code, the federal agency has the right to add and interpret the law. So if there's ambiguity, it's like, well, I don't know, like the code says this and it says that, and I don't know. Well, regulation is to close that gap, and usually it's in the favor of the IRS. That's not what this is. That's not what this language is. And this is what's super important, how it applies now, because it essentially is the IRS's conduct. You can kind of get an idea of how they operate. And now here we are with a really good, reasonable argument that cannabis ought not be a Schedule I drug, right? And the IRS saying, well, 280 applies until it's not, instead of looking at the code and interpreting it as, well, cannabis, it doesn't fit the meaning of it. They're saying, well, we're going to lean on, is it a Schedule I or Schedule II drug? But does it fit the meaning? Even though the HHS said that it doesn't, the IRS is saying, well, it does until the DEA says, right? They're not following the law, okay, on this. They're not following law. Well, they did the same thing with this regulation. Back in 2021, when the tax accountants were using 471C to get their clients' deductions, they put this blanket regulation down and said that if a deduction is otherwise disallowed by another code section, i.e. 280E, then you can't use 471C. So this was the IRS saying, no, you can't use 4C cannabis industry. And that deterred a lot of people. It worked really well. Ultimately, when this got in there and digging around, and we did out of that ourselves, and we started looking into this, we're like, there's no teeth behind that. Like, it doesn't say anywhere that the cannabis industry can't use 471C. So we went ahead and just kept doing it. And now with the overturning of the Chevron deference, which gave a lot of the conservative tax accountants and tax attorneys, they were like, oh no, the IRS is going to come and get you. They're like, oh, but wait a second. Well, now that we can go around the IRS, maybe willing to fight that battle. And so a lot more of the accounts are using that. Now that 471C is for any business under $29 million, by the way. So if your gross revenue is above $29 million, then This is limited. Your use of 471C is limited. But with the argument that 280E doesn't apply, that's for everybody. All right. Those are the main tools that we have. I want to leave it open for questions. We've already kind of went over what people are doing. As you know, Trulieve got their $113 million. There's a lot of MSOs that are going for without reducing deductions for 280E. There's a lot of businesses in general that are going forward without reducing deductions for 280E. There are people amending returns. I wanted to touch base on statute of limitations. You have 3 years to amend your return for a refund. And that means you need to, if you want to amend 2021, you need to do it quickly because the statute of limitations run out this year. There is what's called a protective claim for refund, which is a letter. You can submit it to the IRS to keep your statute of limitations open. But that means some sort of judicial thing has to happen where the IRS does argue this in tax court, where the Supreme Court does in the favor of these companies that says, well, rescheduling should have never been a Schedule I drug. So now you can go back and amend, but I don't know if that's going to happen. So it's almost like in a way, it's up to you. It might be better to just go for a refund. So you have 3 years or 2 years after the date that you paid the tax. So if you haven't ever paid your tax and you're paying it now, whenever you started payments, then the two-year clock starts to run. All right, let's see. The next slide was about protective claim for refund. All right, go ahead and go to the next slide there. One question that comes up regularly is what businesses should be hiring an attorney and what business shouldn't or don't necessarily have to. The businesses that we work with are definitely small businesses. They're typically under the 29 million gross revenue. We use 471C for them. We use a form called the 8275R. We have some legal language that we purchased from a tax attorney that we include in there that present our arguments. That 8275R, that form is what you use to inform the IRS that you're taking a position is not the same as what they think is legal. So in my opinion, the opinion of many of my colleagues, that's good enough. You don't necessarily need to hire an attorney to write an opinion for you. When you get into like asking for refunds for $2 million or more, and then it might not be a bad idea to talk to an attorney. I know there's plenty of attorneys that work with larger companies, and it makes sense to hire an attorney at that level because you want to get like a little bit more, behind the position. The attorneys can do that with an opinion letter. And it typically is very expensive. And in fact, I was on a panel at MJBiz, and unfortunately, when I was there and the question came up, can we do a refund or can we amend for a refund? And the gal said, well, if you want to spend hundreds of thousands of dollars on it, well, that's not necessarily true. The 8275R will protect you from penalties. So if they decide to dispute it, using a professional and providing a reasonable argument for your position, you can be protected from penalties, and therefore, oftentimes you just end up back where you were if you don't want to take it to tax court.
Justin, this is Omar. I do have several more questions if you're ready for me to throw them at you.
Go for it.
So one of them is it's from Justin Habemeyer, and he's asking, can you give a simple example of something that cannot be deducted under 280E, but can be under 471C?
Well, again, the language in 471C is very clear that you can choose what you include in your inventory calculation, what you don't. Our practice has always been to exclude discretionary spending. So we'll throw 100% of facility costs and everything having to do with it, 100% of payroll and everything having to do with that, including recruiting and processing fees. And then like the licensing, the menus, the online menus, the POS system, all of that. I think things that we don't include are like advertising, I would say. And then professional fees are debatable because you don't necessarily need to hire, I don't want to say a good accountant, you got to have a good accountant, but it's not necessarily, it's not an essential for conducting business. That's always been our narrative from the very beginning. 5 years ago when we were doing this, that was our narrative right at the beginning. We're going to throw the IRS a bone, but we're gonna deduct most everything.
Okay, excellent. Thank you for that, Justin. Another question that's come in actually from a couple of people is how many of your clients have been audited, and what are the chances for an audit?
Yeah, so I've never had a 471C dispute. And we've only been amending returns middle of last year and going forward with no 280E for 2023 returns. So it's a little soon to see if they're going to audit our no 280E approach. But as far as our 471C approach, we've not had that audited either. So did have a one back 2018 471A, and then we had a partnership that was audited. That was a holding company. Thankfully, they disallowed some deductions and then went on their merry way. That could have been a big mess. But so far, very few audits of our clients so far, knock on wood, for the hundreds and thousands of tax returns we've done with the 8275Rs and all that. So far, they've been leaving us alone. Maybe up until this this webinar, but I hope that answers your question.
Okay. Here is one more question I have. I'll just pull it up a little. There we go. It's from William Tice, and he's asking what minimum requirements in lease terms are required for equipment leases of equipment used in cannabis production so that the lease payments are tax deductible as COGS.
Wow, that sounds like that for a CPA exam or something like that. I think that's a trick question. Somebody's trying to trap me or something. Depreciation for equipment. I mean, size of the business, there might be some limitations in regard to the, to depreciation in manufacturing, but say you're under the 29 million threshold, I wouldn't have a problem with bonusing that equipment. And right now, I think, what are we at? Bonus depreciation is slowly expiring since the Tax Cuts and Jobs Act, so we're getting less bonus depreciation. But you could also 179, which I think is $1 million or more. I'd have to do a little research on that, but don't worry about 280E on that. That's all related. That's all cost of goods sold for processing. Yeah. Absolutely. Like, you're going to get whatever your deductions are for that. Okay.
Now, Kid, can you explain specifically how you would apply 471C on a tax return?
Yeah. Well, it's a little bit complicated. You do have to elect the method. So it's a Form 3115, which is a change in accounting method. You have to request to use 471C. People are amending and going back and amending and adding 471C. Unfortunately, that is actually not following the rules. You can't necessarily go from like cash or accrual method and then attempt to use 471C, but you can do it now going forward. So for your 2024 tax return going forward, you could do what's called a 3115, elect to use 471C. Then what you do is you can, you need to prorate your ending inventory, all your COGS or your overhead costs. You need to prorate it or figure out how to apply your overhead costs to inventory and then thus deduct it as COGS. It doesn't be complicated, but it is a little bit of a calculation, a little bit of accounting acrobatics in order to figure out like, okay, what part of that is considered cost of goods sold and deductible this year? What part of the overhead gets to be added to your ending inventory? There's what's called a 481A adjustment. It's another kind of complicated thing that comes with the 3115. I'm not trying to dissuade you from using it. It's very, very valuable. I'm just saying that you might need to talk to somebody who has had experience in 471C. Then we also put in 8275R, telling them like, hey, your regulation back in 2021, we saw that, we get it, and we don't agree. Because we don't agree. We think that 471C does apply. You can use it. The IRS has not, from what I've heard, disputed in tax court 471C yet, even though they said, and they were doing lots of saber rattling, a lot of saber rattling, no, that it hasn't been taken to tax court. And it doesn't sound like they're taking it to tax court. They're allowing that method. And so that's good news for you guys. But you'll probably have to talk to a cannabis professional in order to get that implemented properly.
Excellent. Thanks for that, Justin. Another question that we have is if 280E is, left out, if cannabis businesses have to or, aren't paying it, how much does that add to a cannabis business's bottom line?
Well, it depends on where you were with your prior accountant. Were they going conservative, or were they pretty aggressive with 471C? From my experience, like most people these accountants were disallowing like 40 to 50% under like a 471A methodology of overhead. And so it really depends on how big your business is. The bigger the business, the more free cash flow they had in order to be able to absorb the phantom income hit and still pay the taxes. The smaller the business, if you were like under $3 million in gross revenue for the year, you got screwed. So for them, it was if you took a face value 280E approach and just disallowed your overhead, you were paying a 70 to 90% tax on like say 30 million, well, it was whatever money. If you even had positive cash flow, you would pay that much. So I can't say with any certainty about that, unfortunately, but I can tell you that it's hundreds of thousands and millions of dollars in taxes that were paid on this phantom income and are being paid. So you got to do something about it. 471C gets you way down to near legal levels. So whatever that means for your business, 471C will get you way down. Then you can say like, okay, and also we're not going to reduce deductions for 280E. That's what many of my clients have decided to do. They're willing to take the risk. There is a risk. I don't know what the risk is, but I have to say it's high just because I don't know. I've not suffered the consequences. We haven't suffered yet. So, but I can say that, that if you use 471C and then reduce deductions or do no 280E, that incremental difference is not that much. But compared to what some accountants are doing, where they're disallowing like 50% of their overhead, that's huge for a business.
Excellent. Okay. And coming down the home stretch here, maybe just one, possibly two more questions. But the next question would be, when you make these kinds of appeals or challenges to 280E, do you include your reasoning in amending the return in terms of why 280E does not apply?
You do. You definitely do. You have to let the IRS know that you disagree with them. And you do that through the form 8275R. It's a disclosure that the other accountants often joke, well, the R is for request for audit. That has not been my experience. My experience is that we have sent in probably thousands of tax returns that have an 8275R in them and have not had them audited. So it doesn't necessarily mean you're going to get audited, but you do need to include it, and you can maybe get an attorney to do a write-up for your disclosures. Some of them will refuse. They'll say like, oh no, this has to be an opinion, like a big drawn out opinion, 100-page opinion letter. But there are attorneys that will do like a 3-page. We have a 3-page document that challenges the IRS's opinion. And so that's what we include in the 82 with these amended returns.
Excellent. All righty. And I'll make this the final question. The questioner, he or she says that they agree with the logic of what you're saying, but there are other CPAs who don't agree with this logic. So why do you think there is so much pushback from some of your fellow CPA peers?
I think that I honestly don't know, but I think that a lot of people are scared. They're afraid to bump up against the IRS. They're afraid to test the boundaries of what they could do for their clients. They might have a very solid opinion about their approach, and they are not open to changing it. I do know that like a lot of people, a lot of accountants are very like we're rule followers. We're very conservative. We're rule followers, and if the IRS says that 280 applies, it applies. And you're putting your clients at risk. This is what people tell me. Your clients are going to get audited. They're going to get penalized, and they're going to be really sorry. And so then I do tell my clients, hey, like you could be really sorry, but how much is that worth to you? What's the risk worth to you? Is it worth $100,000? Is it worth $200,000? Is it worth $300,000 to take that risk, to potentially suffer the consequence of a drawn out audit experience? If you've got good books and records and you can like produce for your, from my perspective, which I don't have a lot of, I have a lot of experience working with the IRS. I don't have a lot of experience defending my tax returns. I think that there's bigger fish or lower hanging fruit to attack. The IRS can attack lower hanging fruit, but essentially I give them the option. I'm saying like, hey, I don't know what risk is, and I don't really know what the damage that could be done. Some people have experienced it and they write articles about it and they say like, oh, it's the worst ever. But, even the high profile cases like Harborside, not the most recent one because the subsidiary of Harborside got audited and then the penalty stuck because they had bad books and records. But the other ones like Harborside itself and some of the other higher profile cases, those guys, the IRS abated penalties on all of them. So they ended up back where they were, less the attorney fees, so they had to pay attorneys a lot of money to defend them and all that. But like these smaller businesses could be, I think these smaller businesses could maybe not be hammered quite as much. So it's a little bit more worth the risk, I think. But there is a risk because the IRS said no. I feel like if you follow the logic, we have a very, what's the terminology I'm trying to think here? Confidence, that's what the attorneys call it. There's a 95+% confidence, there's a 95% confidence, and there's a 50%, more likely than not, confidence. And I think that this is definitely more likely than not that we're on the right side of history here.
Excellent. All righty. I think that's an excellent note to finish up on, Justin. And yeah, we appreciate your insights and a lot of valuable information you've provided us and our audience. And once again, apologies for the technical glitches that we've had. This recording will be available later on. And thank you for joining in until next time.
All right. Thank you.